Welcome to This Explainer. Today, we're exploring a seriously fascinating roadmap for long-term wealth creation. Imagine stepping into the vast, dynamic world of the Indian stock market for a second. Honestly, it can feel totally overwhelming, right? But what if you had the exact right tools to find your way? Well, in This Explainer, we're going to look at market benchmarks as our grand map, giving us the lay of the land, and fundamental analysis as our personal compass, pointing us straight toward true north.
So here's our agenda for today's journey. 1. The Indian market benchmarks. 2. Calculating the index value. 3. What is fundamental analysis? 4. Creators versus destructors. 5. Fundamental versus technical analysis. And finally, number 6, the core satellite strategy. Let's dive in.
Section 1. The Indian Market Benchmarks. Let's start out by looking at our map. This is basically the overarching battlefield of the market. And to navigate it, we first need to understand the macrometrics that dictate its overall health.
Okay, when you watch the business news, you constantly hear people throwing around the terms Nifty and Sensex. They're the ultimate benchmark indices that everything else is measured against. But what's the actual difference between them? Well, it breaks down like this. The Nifty 50, which is managed by an NSE subsidiary, represents the top 50 actively traded companies. It covers a really broad 24 sectors, and it's calculated from a base number of 1,000 starting back in 1995. Now, on the flip side, we have the older legacy index, the S&P BSE Sensex, introduced by the Bombay Stock Exchange. This one tracks 30 top companies across 13 sectors. It originates from a much earlier base period of 1978 to 79 with a base number of just 100. So, despite their differences in age and size, they both give us this absolutely vital temperature check of the Indian economy.
Section 2. Calculating the index value. Now that we know what these indices actually are, let's strip away all the complex jargon and see the actual math behind them.
Right, so before we can calculate the index, we have to understand a very specific metric, the investable weight factor, or IWF. You see, both Nifty and Sensex don't just look at a company's total massive size. And honestly, that's a good thing, because otherwise a handful of absolute behemoths would just skew everything. Instead, they use what's called free float market capitalization. And the IWF is kind of the secret sauce here. It represents only the proportion of a company's shares that are not held by directors or promoters. These are the shares that are literally just floating around, completely available to be freely traded by regular, everyday public investors like us.
The actual calculation is incredibly simple once you get the hang of the IWF. It's basically just a clean 3-step recipe. Step 1. You take the outstanding shares and multiply them by the current price. That gives you the total market cap. Step 2. You apply our specific metric. You multiply the investable weight factor by that market cap. This trims the fat and gives you the free float market cap, the real, tangible public value. And finally, step 3, you just divide that by the base index value to get the exact benchmark number you see flashing on your TV screen. It's a beautifully logical system for tracking value.
Section 3. What is fundamental analysis? Having mapped out the macro environment of the indices, it's time to pivot to the individual investor's compass. This is how you actually navigate picking the right individual stocks.
You can think of fundamental analysis a lot like tending to a growing plant. It is definitely not about watching a screen flash red and green every single second until your eyes bleed. No way. It's a holistic, long-term approach to studying a business. It requires you to completely ignore the daily, short-term noise of stock prices. Instead, your focus is entirely on the underlying business performance over a 3 to 5 year horizon. If the business is fundamentally strong, the stock price is eventually going to reflect that and appreciate over time. That is how you create true wealth.
Now, you might be thinking, do I need to be a finance professional or a chartered accountant to do this? Absolutely not. The essential tools are surprisingly basic and totally accessible. First, you need annual reports, which you can literally just download from the company's website. Second, industry data, which is usually available for free on association websites. Third, daily news, or just setting up simple Google alerts to stay updated. And finally, MSL for basic arithmetic. I'm talking simple addition, subtraction, division, and multiplication here. With just these 4 mostly free tools and a bit of common sense, you can produce research that genuinely rivals institutional investors.
Section 4. Creators versus destructors. The primary goal of using our fundamental compass is incredibly simple, yet absolutely vital. We need to separate the investment-grade wealth creators from the catastrophic wealth destructors. Let's look at how this plays out in the real world. Take Eicher Motors, for example. This is exactly what a wealth creator looks like. Over the long term, fundamentally strong companies appreciate massively.
The historical data tells us that a 20% compound annual growth rate, or CAGR, will double your money in roughly 3.5 years. But Eicher Motors, they showed a staggering 104% CAGR since 2009. Companies like Eicher, Infosys, and Bosch India, they have this incredible momentum when you zoom out and look at the long-term underlying business strength.
But we really have to contrast that amazing success with the darker side of the market. We're talking about companies like Suzlon Energy, Reliance Power, and Sterling Biotech. These are classic wealth destructors experiencing massive, honestly devastating declines over the years. The crucial takeaway here is that wealth destructors share common, identifiable traits, just like wealth creators do. Your fundamental analysis compass is exactly what helps you spot the traits of these sinking ships way before you put your hard-earned money into them.
Section 5. Fundamental versus technical analysis. So this brings us to the elephant in the room, right? If long-term fundamental analysis is so incredible, why does anyone even bother with short-term technical analysis?
It really comes down to what you're trying to achieve. On one side, fundamental analysis is your engine for creating long-term wealth. It's all about identifying the strong underlying businesses we just talked about. On the other side, technical analysis is about capturing quick short-term returns. It helps you time the market for much better entries and exits. Think about years when a stock is just moving sideways and consolidating, meaning fundamental investing isn't yielding immediate returns. Well, technical analysis allows you to take short-term trades during those lulls. So it's really not a matter of choosing one over the other. They can and absolutely should coexist in a smart market strategy.
Section 6. The core satellite strategy. So how do we actually blend these two together? Let me introduce you to the ultimate actionable framework to deploy both the map and the compass effectively.
Capital allocation elegantly breaks down into what's known as the core satellite strategy. Let's say you have a corpus of 500,000 rupees. You don't just split it down the middle. Instead, 60% of your capital goes into your core portfolio. This chunk is driven entirely by fundamental analysis, holding fundamentally strong companies for the long haul, where you might expect a 12 to 15% CAGR. Then, the remaining 40% becomes your satellite portfolio. This is your active, short-term trading fund using technical analysis, where you're aiming for a 10 to 12% absolute return yearly. This structured approach protects your main wealth while still allowing you to actively capitalize on market timing. It's the best of both worlds.
So we've covered the grand map of the market indices, the math that drives them, and that all-important fundamental compass that keeps you safely on the path of wealth creation and far away from those devastating wealth destructors. So I want to leave you with this provocative question to ponder as you look at your own financial journey. Is your current portfolio built on daily speculation or true fundamental investing? Thank you so much for joining me for this explainer. Keep learning, keep analyzing, and definitely use your new compass wisely.